Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Jannick Malling. Jannick is the co-founder and CEO of the investing platform Public.com. Public has raised more than $300 million from investors including Accel, Greycroft, Lakestar, and Tiger Global, as well as celebrities like Will Smith, the Chainsmokers, Watt and Maria Sharapova. In Public's short life, Jannick and the company have experienced the COVID market crash, GameStop, the 2021 to 22 crypto meltdown, and rapid interest rate hikes, all while building a community-led finance app for engaged retail investors. In this conversation, Jannick and I discuss building a community-led business, fans versus users, counterintuitive learnings about retail investor psychology, the future trajectory of retail trading activity, running a company that ships product fast, and more. Thank you very much for joining us today. Please welcome Jannick Malling. Jannick Malling, welcome to Rebank.
Thank you so much.
It's an honor to connect with you. I've been tracking your progress at Public for a long time now. I have a number of questions that I would love to dive into with you. I think the audience is aware of Public. You're a leading retail investor app. You have a ravenous following, from what I can tell. Your customers really love you. And I think that sets you apart from a lot of fintech. Maybe we start there. First question for you. What would you describe as the main value prop of Public?
Today, we're really the only multi-asset investing app, neo-broker, whatever you kind of want to call it, where you can build a portfolio across multiple asset classes, not just equities and crypto, but even treasuries, corporate bonds, options trading, even some alternative assets. That obviously wasn't the value prop actually in the beginning. I always think value props have to evolve over time. They're sort of a living, breathing thing. And I'm a big believer in this saying that as a startup or a founder, you need to find product market fit 3-4 times in your lifetime to really have it go anywhere. But today, that's what's driving a lot of our customers to move their portfolios to us, is that they can basically consolidate all their investing in one place, and they don't have to use one app for crypto and one app for options trading and one app for bonds and buy some treasury bills on Treasury Direct or whatever, right? Which becomes a fairly disjointed experience. And there's just so many downsides to have your financial investment portfolio spread out across all those things. You're not able to easily see consolidated performance reporting. It's a pain from a tax perspective, et cetera, et cetera. And so, yeah, that's us in a nutshell. I think in addition to that, I always talk about the fact that I think the two fundamental things that a company like Public really has to do is enable people to invest in stuff they want to invest in. So that means having all the asset classes, having them available fractionally, as it were, meaning you have low minimums on them, and then keep people informed and up to date and have them continue to be educated as they go along. Really distill it down. That's what it is. Now, that's a lot harder than it might sound because it sounds pretty simple, but I think the ways in which you do that becomes what set you apart. And so one of the other things that I think Public has managed to get a lot of positive feedback around is the way we keep people informed about what's going on in their portfolios is multifaceted, first of all. So not just news, et cetera, but there's a whole community that's pretty vibrant where people talk about their investment ideas, et cetera. More recently, we've layered on Alpha, which is an AI research assistant integrated into the product that tells you whatever you want to know about your portfolio. You can just open it and ask any question. So there's an earnings call that comes out and you own that company. It'll come and tell you, this is what went on in the earnings call. This is what you might want to pay attention to. And you can have a conversation with it about that. But yeah, at the core, that's really what we do. Enable all these asset classes to sit in one place. Then you easily build a diversified portfolio and then keep you informed and engaged in that portfolio in the best, most frictionless way possible.
All right. So all of that makes sense. And I can see why people could like that set of functionality. My background is actually in investments. I've certainly spent a lot of time thinking about the space. You're really, yes, offering a series of functionalities that people can use. There are tools to ultimately achieve something. People come in with a clear intention, and there's pretty strong, I imagine, homogeneity of intention in an investing app, which is to make money. in a sense, you're offering a service, and I imagine trying to optimize for an outcome for your investors as well, which is to make good investments and maybe think about the time horizon that they're trying to do that over and various things. How do you think about the personas among your customer base?
Yeah.
And how does that influence the way you have built the business?
Yeah, it's a good question. So first of all, I think you're right. It is a tool, but we actually never really use that term. And I guess the reason why is another huge component outside of the features is just trust, because you don't always need to be able to trust a tool in order for it to be useful to you. But specifically in the position that we're in as a broker dealer, trust is just very important, right? We're dealing with your money. It's important for many of our customers to know that our incentives are aligned with them. And so we've done a number of things to make sure that that's very evidently the case. Things like not accepting payment for order flow in the equity space, in the option space, where we do engage in payment for order flow, we give back half of it directly to the customer. So we still have our incentives be aligned, because the option space basically doesn't really work without payment for order flow. It's something you can't really remove. And so that's another huge component, I would say. One is the technology and the tools, but the other one is just trust. And I think different personas kind of have a different ratio of which they value more or less. So there's definitely a persona that cares less about all the bells and whistles, just want to build a very simple portfolio that they can hold for the long term. And there I would say trust is kind of more important. And then there are some other personas where it's like, while trust is always important, I need these tools to be able to consolidate and move all my investment portfolio here. I guess you could roughly break that down a little bit into, we often talk about like the active trader. They tend to be the power users of the space. They're a little bit more engaged. They require all the tools. They still care deeply about trust, by the way, everybody does, but they require a deeper tool set. And so they maybe value it more 50-50. Whereas the more long-term investor, a little bit more passive, still actively engaged in their portfolio, but that doesn't mean they're day trading every day. That might just mean that they're consuming all the content that gets generated around their portfolio by way of market news, market events, earnings calls, and so forth. And that's where Alpha now plays, our AI assistant, increasingly plays a more important role in summarizing everything that's going on, because there's actually a lot going on, and just letting you know what the TLDR is and what you need to keep your eyes on. That's generally how the space always have kind of shaking out. And by the way, that often has been classically the definition, right? The passive investor, the active trader. We started out being a little bit more in the middle there, very purposely, very much by design, because we definitely had this thesis that if you want to build a platform that can cater to both, it's really hard to start only in one of those two camps, right? It's really hard to start with a completely hands-off, press run button, never look at it again. It's all managed for you, and then suddenly go into the active trading stuff. And conversely, I think it's hard to start in the active trading stuff and then go into sort of the more passive business. But we had this middle out strategy almost. But if we start building something that captures a little bit the hybrid between those two personas, which also at the time was a growing market, we found, then that's a great place to start. And then we can chip away a little bit and move from the middle and build the platform in a way where it covers more ground all the way out into the fringes, right? And so today, we're not the place where the most hardcore active traders are, and we're also not a financial advisor. We are something new in the middle that increasingly, I think, is able to take share from both of those camps as we build out the platform.
That's actually a perfect segue into the next question I wanted to ask you, which was, I realize that I'm at risk of probably overgeneralizing here, but at the highest level, I think about retail investments maybe a generation ago as having been broadly in the hands of the largest institutional asset managers and then stockbrokers, people more or less like providing advice to investors, retail investors, as to how to invest their money. And then internet era, Y2K, online brokers, you could come in and basically self-direct your own trading. And then more recently, over the past 10 years or so, mobile first, great customer experience, coupled with things like active communities on Reddit and Seeking Alpha and various other online investment news outlets, a more proactive, user-led approach to investments. Yep. I wonder what your gut feel is around, firstly, tell me if you think I'm characterizing things correctly or not. And then if so, what's your sense of this evolving market? Do you think there's going to be an increasing emphasis as people think about their investments across their portfolio and across their lives, more self-directed, active trading through mobile apps? Do you think that people are going to evolve from one type of provider to another throughout their lives, or have 10% on a trading app and 90% managed by Vanguard or BlackRock that they never see?
I definitely think your characterization is pretty spot on. And what's evident there and what you're saying is whenever there's a technological shift, like that's actually what's driving these huge moves in consumer behavior. So to your point, brokers coming online cause more people to do it themselves. You go mobile, fractional, zero commission, you have that on steroids. And so the trend has definitely been going towards doing it yourself. And I think it's rooted in a couple of things. As people started participating in these communities, they also started to realize of like, well, if I'm paying for advice is not free. You're typically paying these firms a portion of your assets. Then some people sort of have to know something that I don't. And I think especially after the financial crisis, there was this big revelation amongst many retail folks of like, hey, maybe the suits, so to say, actually don't know anything that we don't. Maybe they just get paid more. And I think all of us who's worked in the finance industry know that there's definitely an element of truth there. And fast forward, you then now have, during the events of GameStop, for instance, very sophisticated short squeeze setups, that research report essentially being written by somebody who is quote unquote just an amateur. Nevertheless, that thing was a work of art and probably more sophisticated than most of the quote unquote professionals could have done. And so I think you've come completely full circle on it. Another good expression of that is actually Bitcoin. Satoshi wrote the white paper at the same time as the financial crisis happened, coincidentally. I don't think he could have foreseen that. That just ended up happening to be a coincidence, I think, in '08. Bitcoin started completely retail. Everyone in the classic traditional institutional finance world falls completely ludicrous. Fast forward to very recently, ETFs are now out on these. Institutions are buying Bitcoin quite massively. So that's a market that actually started 100% retail, and now it's becoming more institutional. But as you've had that other movement, the data shows that I think 10 years ago, retail participation in the stock market, in the equities market, was less than 10%, like 7, 8. Then it jumped to 20, 25. It's been upwards of 30 just in these last few years. And so I think you're definitely seeing that trend being one directional so far. Now, to your question about what's going to happen in the future, I think that's going to continue. I don't think that people will... It's easy for a financial advisor to... Let's disregard the billionaires and the 100 millionaires out of this conversation. Let's just talk about like regular folks. Like I don't think... If you've become very financially literate yourself by doing it yourself, it's a lot harder for a financial advisor to sell you their value proposition and their services. Why should you use them? That question is a lot easier for a financial advisor to sell you on if you don't know anything. And so as everybody kind of becomes more literate themselves, and ultimately that's what I think has happened here with our generation, is just like an explosion of financial literacy. Everyone and their mother now knows what a short squeeze is. I mean, like, if you told me that 5 years ago, I would say you're crazy. But that's just what happens, and that's just the power of social media and everything that we've created in this world, and that's where we are. And so therefore, I don't think it's gonna change. The only thing that I could see changing, going back to technological shifts, drive a lot of this, is a world where maybe AI plays a role and helps you. I wouldn't say be an advisor, because I don't think it's as simple as like AI is going to replace advisors. I kind of think it's going to be very different than that. It tends to be also like people are not just like displacing each other when technological shifts happen. It tends to be more something new comes up and people gravitate toward that, rather than like a one-for-one straight disruption. I think that's what you might start to see with AI now. But I think the first phase of that, at least what we're seeing, is AI is a tool that is a great equalizer as far as investment research. It used to be, if you're on a hedge fund, you got 10 analysts working for you. You can get a lot more research done. You can cover a lot more ground. That actually gives you an advantage in the markets relative to the average retail investor. But you're starting to see that advantage coming a little bit apart as you can now research things 100 times faster with AI, which is a little bit like having that team of researchers in your pocket now, just being able to ask any question and get an answer immediately and have this like conversational research kind of process that you would have with a team of hedge fund analysts in a meeting, riffing ideas, etc. Right? And so I think in the short term, that's going to drive people to become even more experts, which is going to drive the trend even more towards do it yourself. And then to the degree that it's not do it yourself, maybe it becomes do it more with AI. But like I said, I don't think that's going to be completely passive ever. I think that's going to be some other new hybrid of like active, and then you can debate who's executing the trade and who's getting the idea. And it's more of a collaborative approach.
Are you talking about just ChatGPT to query markets, or are there specific tools that you're thinking of when you make reference to some of the AI?
Yeah, that's a good question. I mean, I'm thinking a lot about our own solution, of course, because that's the one I use the most. But I think generally, and we have built on top of OpenAPI, but basically what we did is large language models are great at language. They're not great at math. Investing involves some math. And so we saw an opportunity early on to build a hybrid where left brain, right brain type situation where like OpenAI supply the language part of the brain, and we actually do the math, and we have all the data in a structured way, et cetera, and we can supply all that. Because while the public markets are public, all the data is public, it's not structured data, it's very convoluted, it's earnings reports, it's earnings called transcript. There's a lot of data work that goes into making sense of that from an AI perspective. And so that's where we think there's always going to be some advantage that I don't necessarily see ChatGPT being able to just get into without another huge leapfrog. And so I think, you can use ChatGPT for some of it, but I think there is an increasing amount of finance investment specific AI tools that are further ahead, at least right now, in terms of the quality. And quality is so important, right? It's not like when I ask ChatGPT to make me a recipe or something and I mess it up, well, then I'm going to have a less than perfect dinner. But if I ask ChatGPT something and they mess it up here, I might invest into a misguided sense of whatever. And so, quality matters a lot more here, as is always the case in finance. That's always been the case, by the way, right? That's always why finance has been like the late adopter of new technologies. To a degree, still are. I don't really actually know of any other neo-broker with a built-in AI other than ours. I suspect more will come. But generally speaking, the bar for putting out new product is a little bit higher in the financial world because you got to get further ahead before you can really release it and have it be ready for prime time.
Can you talk more about the fan base element of public users? It does seem to me, as an outsider, that there is a genuine, I don't know if loyalty is the right word, but some sort of deeper than standard brand relationship feeling that a lot of the public user base has with the app or the company.
Yeah, no, totally. So we've always thought that most underestimate the power of brand and like really what that word actually means. You're right. The way we talk about it is build a fan base, not just a user base. And it goes into, you want to have people that use your product, not just because it's a little bit cleaner, or it's a little bit better, or it necessarily has one of these two extra features. Like in the perfect world, you want to have them be all in with their heart as well as their brain. And to do that, the way you got to approach what you would call marketing, I think is very different, right? Most people see marketing as you run some ads and you do some stuff, and et cetera. We obviously started with a built-in community as part of public, so that's never how we thought about marketing. We always thought about marketing from like a community-first approach. Normally, investing has been a little bit like single-player mode, right? You look at one screen, you see your stuff, that's it, and it's disconnected from everything else. But that community approach allowed us to create a platform where a lot of people were talking, collaborating, and that actually allowed us to be a lot closer to our customers, which is something that I still believe that I would say that we are today. We're closer to our customers than anyone else that I know, at least. And a big part of the advantage there has been having this built-in community as part of the platform where people are openly sharing ideas, not just on like the stock market, but also like ideas about the platform and how they think about building out their portfolios. And if you're a good product person, you can pick up a lot from that as far as signals and going where you might want to go. You're closer, and then you're more often than not able to deliver what they want, which has this a little bit over time creates the sense that you really understand their needs and you want to be there for them, help them achieve whatever it is that they're trying to achieve. And that is really how you build, I think, a lot of customer love. Yeah, a fan base and not just a user base, right? And so one of the best examples of that was shortly after the events at GameStop, everybody started to becoming more aware of this concept of payment for order flow. which is a way broker-dealers have historically getting remunerated from stock trades because they will send them to a dark pool market maker instead of to the stock exchange. Honestly, I'm in New York, if I go stop 10 people on the street right now and say, what do you think happens when you buy a stock? Where do you think that order goes? Everybody would be like, it goes down there, right? The stock exchange. That's not what happens in almost all other instances than if you do it on public. And so that was just us realizing, oh, now there's this disconnection. People felt almost fooled in a way, I would say. And we were able to really quickly pick up on that because we're seeing all that chatter happen on our platform organically. And by the way, we were actually doing payment for order flow as well at the time because it just like comes out of the box, if you will, when you set up a broker dealer. It's just like kind of how it works for most clearing firms and whatnot. We'd always thought about going off of payment for order flow, but there's a lot of things you think about, and then priority meetings happen and you got to pick one before the other. And so we'd never gotten around to it. But then we decided, okay, now's the right time to do that. And so we executed on that over the course of a weekend. And that's something that just created a ton of customer love because I think people were able to appreciate that. They were very frustrated about a certain issue. We understood that frustration. Not only did we understand it, we took action and did something about it in a matter of 48 hours. That's a prime example, I think, of how you can help build that fan base and not just a user base.
From the time you started public, or at least the time that you launched, which I think you said was in 2019, to now, I mean, we've witnessed some really fascinating and potentially unique price movements. Yeah, everything from what we saw through COVID, just ripping, especially tech stocks, growth stocks, and that came to an abrupt halt in late 2021 into 22, crypto on the same arc. And things were then pretty dismal for a period of time until when no one was looking, markets started to rip again. And that's now bled into things like crypto and other risk on assets at a time when it's not clear exactly which way interest rates, or rather how quickly they're likely to be rolled back. It's just kind of an interesting moment. There is, at least as we're speaking, it's mid-March 2024. There's been a lot of volatility in markets lately. Having observed all of this with an N of millions, I imagine at this point, in terms of customers, what have you learned? What have your takeaways been from all of this?
A lot of different things. I mean, you're totally right. We're essentially, as of this recording, a 4.5-year-old company that's been through every market cycle imaginable, all the way from COVID, huge drop. By the way, when that drop happened, we were like obviously getting emails from investors. We had just raised some money, so we felt pretty good. Like we had a lot of fresh capital in the bank. But we also have a use of proceeds, like a plan to spend that capital that literally 72 hours earlier, everybody had signed off on, and great. And then everybody was like, oh, hold back, save the money, What happened is obviously the markets dropped in like a flash crash type scenario. I think they hit 4 or 5 circuit breakers, which hadn't happened since, you hadn't had a circuit breaker since the 80s, I believe. So, that's when the S&P goes down more than 7.5% in a day, which is wild. I mean, it's still wild to think back to that time. A lot of the millennial generation, especially, which makes up the majority of the member base on public, just saw that as a huge opportunity to buy in. And I know that in hindsight now, having talked to so many of them, a lot of people had been looking at that chart of '08 and felt like that would have been a good time to buy, like when they're looking at it in 15 and 16 and onwards. So when that happened in 2020, a lot of people were like, you know what, this is my opportunity. It became like a Black Friday effect for the stock market. So we learned there that actually, contrary to popular belief, the market's going down is not a bad thing necessarily. It depends a little bit on how it's happening. And so it's way too much of an oversimplification just to say that any investment company, it's good if the markets go up, it's bad if they go down. Like there can be positive aspects of both. So that's what we learned there. Then obviously during GameStop, a lot of things that we believed in our core turned out to be true, probably more than we initially believed, specifically around social, the role that it could play in investing, etc. But I think we equally learned something interesting in the markets of 22 and 23, which was tech especially started correcting. And I think generally people in the millennial generation like tech companies because they invest more longer term than older generations, obviously, and they see a lot more upside there. That's when we had to now reintroduce this whole audience to the world of bonds. And that was an interesting experience because, well, now suddenly bonds are giving you 5% risk-free yield. And people are like, wait, what, risk-free? Is that even a term? It's like you've spent actually the last couple of years educating us that nothing is risk-free. and we're like, that's true, except this, except actually just like a high yield cash account or a 6-month T-bill, which I know with the debt ceiling, it's technically not 100% risk-free, etc. But I think it's the safest thing out there. It's backed by the US government, etc. Right? With every market event and every market cycle, there is just a huge opportunity for learning because at the end of the day, learning works best when you do learning by doing. I think that's true for all facets of life. By the way, if you do learning by doing in multiplayer mode, that's by far the best thing, which also is a little bit how it works in many other industries. It's a very real-time thing that people are discovering in other asset classes, and we have to like inject it into the platform, integrate it, and then educate them on it and do all those things. And so the core lesson beneath all that, which is I think the one thing that we do best, is just speed to market, like the pure shipping velocity of our teams from designing a product, building it, engineering it, integrating it, legal review, compliance review, marketing it, go-to-market plans, all that stuff. It's a lot of work. And especially in larger firms, it takes years what we can do in weeks. And that's been a little bit our number one, I would say, unfair advantage, if you were to call it that, because that means we don't have to try to predict where the market is going. We can actually react to it, but react fast enough that we can still make the most of those market events. And that's why we've decided to continue to be a lean team. We're 100 and something people at Public. We're not thousands of people. It's a technology company. Like a lot of the stuff runs in code, and it's not an operations desk of 1,000 people saying they're executing your trade. Another big benefit of that is, and I know it sounds crazy, but I think there's a lot of evidence also these days, smaller teams can move a lot faster. They can't necessarily get a lot more done. It just means they can pick one thing and do that a lot quicker than anyone else. And then you could say, okay, larger teams can do a million things at once and then slowly move all those forward. But that single focused model has worked very well in our favor because we've been able to react to some of these market events and make the most of them. And then you meet people kind of where they are, right? If they wake up one day thinking, man, I would really want this to invest in, well, then we should be able to deliver that to you. Not the next day, but still takes weeks or months, but it doesn't take years. And I think that's the key point.
Is it hard to identify and commit to that single focus?
Very.
To your point before, there are tons of competing priorities all the time.
It is. And, it's not like we're that small that we just have a single one. We have a couple things going on at the same time always. But I think it was actually Steve Jobs that had this great quote about focus, which is focus equals sacrifice. And it's about, I think it's him and Jannick and I actually talking, and it's like, we use it a lot internally. Focus doesn't mean that you think something else is a bad idea. It could be a great idea. It just means that you think this other thing is so much better right now that you're actively deciding to do that instead of that other thing. And it sounds super obvious in hindsight, but it's a good quote to remember and print out and put on the wall whenever you have to make tough decisions. It also means you sometimes have to put things off and pick them up later. We've had that in space. But the truth is, when some of these things really happen, yes, focus is always hard, but also sometimes it just becomes so obvious that it becomes easy. You know what I mean? Like when rates went up in an unprecedented way, it became very obvious for us that we should be the first new broker where you should be able to buy T-bills with a click of a button. Because we just think that was going to be a phenomenal investment for our customers and our members, and nobody else was doing it. And it was so clunky the way you could do before. And so we just tried to do that very, very quickly. And same with bonds, same with crypto, frankly. And even as recently as with options, which we only launched kind of recently. And obviously there was a lot of options trading going on in 2020 and 2021. And then now it's come back in a huge way, literally like year to date. And we launched this in January. So there the timing has also proved very, very good. And that's the thing. We're trying to think about timing more as a skill rather than chalk it up to pure luck. I think is the mindset that you want to have.
Tell me a bit about the economics of the business. So you talked about the fan base concept, and I imagine that ultimately has positive effects when it comes to customer acquisition. both scale and then as a result, costs per newly acquired customer, and also lifetime value. I imagine that customers that feel like they're playing a multiplayer game are likely to be actively engaged in the platform for longer. And then also, the revenue streams a little bit. You talked about having given up payment for order flow in most asset classes except options. What's the revenue model?
Yeah. On the CAC to LTV thing, I'd actually say the community sort of approach definitely helps CAC. Organic has always been our largest source of growth. And so there's definitely a lot there that we've played with over the years and that have compounded in many different ways. On LTV, for us, it's actually more the case that when you have a multi-asset platform, you always have a relevant asset class no matter which market cycle you're in for your members. So if bond yields are up, you have a lot of interesting bonds. At that time, crypto was way down. Now crypto is way up. The markets are way up. Bond yields are, by the way, still high. But it's more like if you're playing in all those different areas, you have a much more diversified customer base, which also means churn is much lower, which means LTV is much longer. Like our lifetimes are very, very long. They're not like that of most other trading apps. They're more honestly like the banks. How often do you switch banks? And that's just what we've seen. There's probably a mix of things, but I think that's definitely key among them. Now, those long lifetimes actually allowed us to early on say, okay, on things like payment for order flow, which by the way had a lot of regulatory scrutiny at the time. I think it still does. So we were also just not sure, is this the right smart move to like base our entire business on this revenue stream that might get banned in the US because, by the way, it's illegal in the UK and it's about to be banned in Europe and it's illegal in Australia and Canada. And so like the writing was a little bit of the wall that might not be a great long-term decision. And it's very difficult to change your business model down the line. But when you're an 18-month-old company, it's very easy. And that was our advantage there at the time. And at that time, we basically decided, hey, you know what? We actually don't want to have a business model that is so heavily driven by transactional revenue streams. We want to have something where we're growing with our customer and then are able to make more money, the more money that they have in their accounts. We like that better from an incentive point of view. And so then we sort of refactored the business model to be something that's more asset driven, we call it. So today we've got like dozens of revenue streams rather than just this one thing, which is great because that one thing, if it's tied up in something very volatile, can go up and can just as easily come down. And that makes it very hard to project the company's performance. And a company's which performance you can't project tends to trade at a discount to a lot of other things. So even from a pure business perspective, that's the far superior thing. But it also means from an incentive perspective that it's very hard for people to say like, oh, you have incentive to do this and do that. It's like, well, no, because we have 12 different ways of making money across all these asset classes and so forth. So it's not like that we are overly focused on getting this one thing done and getting every customer to this point, and therefore we're gamifying this and that and the other. Like you can't really make that argument with us when we have many different ways now to make money from our customers. But it's something that we had to build, by the way, since making that decision, right? At the time, we really only had 3 revenue streams live, and it was payment for order flow, share lending, securities lending, and then interest on cash, which at the time was super low. That obviously came back a little bit. And then we built out all these other asset classes where we have various fees. So on our treasury account, we have a management fee. On our high yield cash account, we can grab some bits there as well. We launched Public Premium, which is our premium subscription product. We launched the ability to instantly transfer money in and out into a brokerage account, even from a debit card, which had never been done before, that in partnership with Stripe, and then charge an instant transfer fee for that, similar to the way that Venmo has it, for instance, if you want the money out immediately for like a $2.99 fee or whatever, after hours trading. There's just a lot of stuff that we've launched to create a monetization set that works for all the 3 different personas that we have in various degrees, but that more importantly just makes the business a little bit more predictable and also is the thing that aligns our incentives best with those of our members.
That makes a lot of sense, and it's also very thoughtful. One more question to wrap up. You have only lived in the US for, 6 years or so at this point?
Yeah, something like that.
So you had experience as an adult living abroad, and I imagine investing abroad. Did you have any immediate reactions to the US retail investments market? Did you have expectations coming in, and what was the reality compared to that?
I always say as a European, I grew up in Copenhagen and I lived in London before moving to New York. I was always envious because at the end of the day, the US stock market is just, I call it the Champions League of finance. It's also, by the way,
it's a soccer reference, right? For the American listeners?
Football. Well, soccer. Yeah, sure. Okay.
Football
okay.
reference.
Right.
Okay.
At the end of the day, like, I think you'd be hard pressed to find another asset class with this kind of risk reward ratio that has grown 10% year over year for the last 100 years. That's just a phenomenal investment. Now, in Europe, you're not really exposed to that asset class. There's some weird rules with ETFs, so you can't invest in American ETFs from Europe. It's very expensive if you find ways to get it. So it's just something where like people have tended to invest in the local markets. And so I was always very envious. What a phenomenal thing to be able to invest in. And so I guess when I came over, I did expect that a lot more people would realize how great it is and how privileged one actually is to be able to have access to invest in that for free. This was like 2016, I guess, right? 17, something like that. And even though some time had gone by, like the financial crisis was still this huge event that left really a scar with many people that they hadn't forgotten. And there was a lot of people scared of investing. The culture about investing was like, yeah, it's like a day trader bro kind of thing. Like it sounds very testosterone pumping and it's not for me. And I was like, yeah, that's one version of it. But the other version is do like Warren Buffett does and just put money in the markets and let it work for you. And it's actually much less risky that way and so forth. And so I put that less of like me being your European versus American and maybe more of being someone who's worked in finance since they were 17 years old and had the privilege of understanding all that stuff. And I guess with that sense, the privilege came also like responsibility, like, okay, I should tell more people that they can do this and I should build an easier way for them to do it. And that's how the whole fractional investing idea came up, which was the original hero feature of Public because it didn't exist at the time we launched it. We're essentially the first where you can go and buy a stock in real time for like $10 of Amazon or whatever and actually own that share. That obviously became how the whole thing started. It took me a year still to find out all those things and put everything together essentially. But I was pretty quick to pick up on the fact that there might be something here and that if this cohort of especially millennials, people my age, younger, could start investing when they're 18 instead of when they're 38, which is when I believe the baby boomer generation on average started. That's 20 years of compound investing opportunity that you can never get back. But that would be incredibly powerful. The world would look very differently if everyone had started investing when they were 18. Literally, it would be global economic changing at the highest scale, right? And that's why you're seeing now guys like Brett Gerstner coming out with this initiative where he wants everybody to own stock. I think Bill Ackman's talking about it too. Since they were born, I think that's great too. That's more a political thing, which is not really my jam. So I've decided, okay, let's try to just get everybody open an investing account when they're 18 and invest for the long term. And then that's going to result in something pretty amazing.
Incredible. Well, Jannick, congratulations on everything that you've built. Seems like you're well on the way to realizing your ultimate vision.
Still a long way to go. Only 4 years in still at the end of the day. Always, some days it does feel like it feels like 8 or 12 years instead of the 4, but also hasn't been a ton of sleep those 4 years. So I guess it depends on how you count things. But thanks so much, Will. Yeah, I appreciate that.
Jannick Malling, thank you very much for joining us today.
Thanks.
Thanks for tuning into Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.